Hello. Welcome to our next chapter, that is your IND AS 21, that is effects of changes in foreign exchange rates. So we will first understand what all definitions we will be using, what terminology we will be using so that we can move forward. So first is the presentation currency, that is the currency in which your financial statements are actually presented. So say for example in India, your presentation currency will be rupee. Next is your foreign currency. Foreign currency is another any currency other than your functional currency. So currency other than the functional currency of the entity. This can be anything. Say for example dollar, pound, yen. Okay. Next is foreign currency transaction. So any transaction which is denominated or requiring settlement in a foreign currency. And last is your functional currency. Now, your functional currency is currency of primary economic environment in which the entity operates. So, if your entity mainly operates in India, then in such a case, your functional currency will also become rupee. Now, how to determine your functional currency? How do you identify what is my functional currency? So, there are two types of indicators. First is your primary indicators, and second is your secondary indicators. So primary indicators are currency in which sale prices are denominated and settled. That is in what currency do you sell? Second, currency of country whose competitive forces and regulations mainly determine the sales price. That means wherever you operate of that country, the currency that is used. Third, currency that mainly influences labor, material, and other costs. So if you see, our first two points are related to sales, and your third point is related to your cost. Okay. Secondary is currency in which debt and equity are raised. So if you see your primary indicators were all operational. So currency in which debt and equity are raised. This is your basically finance. And last is currency in which receipts from operating activities are retained. That is in which receipts that are kept. This once receipt is kept, you will use it for something. So basically, this is your investing. Okay. So in what form of currency is your receipts kept? Now, basically, there are two types of items. First is your monetary items, and second is your non-monetary items. Now, what is monetary items? Monetary items is right to receive fixed unit of currency. So, whatever assets, if we are talking about assets, so if you have the right to receive currency, if you have the right to receive currency, for example, any pension paid in cash, any cash dividends, debt securities, debtor, if you see all of this will be settled in cash. All of this will be settled by exchanging money. So therefore, these are your monetary items. And now what are your non-monetary items? Something that will be utilized. So say for example, your prepaid expenses, if you prepaid rent for 12 months. So now this 12 months that you've prepaid, will you get some money in return? No. What you will get? You will get the property. You will get the right to use the property for 12 months. Any goodwill, property, plant, equipment, inventory, income tax received in income advance, all of these are non-monetary items because you are not going to receive anything in cash. So what will be the initial recognition of a foreign currency transaction? It will be at the exchange rate on the transaction date. Exchange rate on the transaction date. That will be the exchange rate that you will be using to record it in your books. Okay, sir. What about subsequent recognition? Initial recognition will be at the rate of transaction date. What about subsequent recognition? Subsequent recognition at the end of the reporting period. That means your balance sheet date. So for monetary items, it will be the exchange rate at the reporting date, that is your closing rate. Because now understand the reason behind this, because you are going to receive money for this sooner or later. You are going to receive it in money terms. Therefore, it is important to have the latest exchange rate. Therefore, it will be the closing rate, that is your reporting period exchange rate. Okay, now non-monetary items at historic cost. That means non-monetary items which will never be revalued. And non-monetary items, basically you're not going to get any cash also against it. So this will remain at exchange rate of date of transaction. That means for non-monetary items at historic cost, initial recognition and subsequent recognition both are same, because this also talks about transaction date and this also talks about the rate on the date of transaction. Next is the non-monetary items at fair value. So basically they are non-monetary items, but you will record them at fair value. In such a case, it will be the exchange rate on the date of fair value determination. That is the date on which you have determined the fair value. The exchange rate of that date only will be used to convert this asset, to convert this non-monetary item. Okay, so I hope it is clear. Monetary items will be there at closing rate. Your non-monetary items at historic cost will remain as it is. That means initial recognition, subsequent recognition, both of them will be same. And your non-monetary items at fair value will be at the rate on the date that the fair value was determined. Next is some other miscellaneous points. So any foreign exchange gain or loss on conversion. So say you will have some gain or loss on conversion. So any foreign exchange gain or loss on conversion is usually recorded in your P&L, that is your profit and loss. But if the asset is FVTOCA, that means you will understand this later when we do IND AS 109, that is the financial instruments. So if the asset is at fair value through OCI, that is your other comprehensive income. In such a case, this will be transferred to OCI. So instead of P&L, it will be transferred to OCI. Next, in cases where two values must be compared, for example, cost or inventory, whichever is lower. So now the question comes, do I first convert it to my convert it using the exchange rate and then compare, or do I first compare and then convert it to my exchange rate? Okay, so in such a case you will first convert cost and NRV. You will convert both the ways to your presentation currency. First it has to be converted and only then will you compare. Okay, so whenever you have to do this higher lower, first convert then compare, first convert then compare. Okay, so there is a small question I put in so that it is easier for you to understand. So in this case our functional currency is rupee. So we call this funda clear question. So on 1st March, you purchased a machinery. On 1st March, you purchased a machinery for $5,000. So that means you are basically importing a machinery. On that date, your currency of rupee per dollar is equal to your 60 rupees. Okay. This is 1st March. Then 31st March. Why is 31st March important? 31st March is important because it is your closing date. So on 31st March, your fair value of machinery turns to 5,500 and your rate becomes 65. So you see there have two changes have happened. First is 5,000 changes to 5,500 and your rate also 60 changes to 65. And last is 31st March 2025. That is after 1 year. After 1 year, when you are making the payment, of course, the payment will be made for $5,000, not for 5,500. Your transaction amount is of 5,000. So this is at 5,000, and after 1 year, that is on date, that time the rate becomes 67. So you had originally assumed to be 60. During the balance sheet, it became 65, and when you have to actually make the payment, it became 67, while your fair value remained unchanged. So in this case, how do you record this entire transaction? So let me clear this so that it is easier for you to read. Okay. Okay. So now 1st March 24, that is your transaction date. So सबसे पहले first is on transaction date. Your entry will be machinery to payable, and all of these figures are in lakhs. So machinery to payable will be 3 lakh. That is basically 5,000. That is basically, oh, I've written it here. Okay. So this is basically your 5,000 into 60. That is your 3 lakh. This 5,000 and this 60. Next is on 31st March 24. Of course, you will have to bring it. You will have to bring it to your rate. So basically, foreign exchange loss, that is your P&L, to payable. Now, why are we multiplying? You have to see why are we multiplying 5,000 and why are we not multiplying 5,500? This something is very, you have to make very clear, because your loss because of exchange rate will only happen on the amount that you have to pay. So you are only going to pay 5,000 rupees. So your calculation will also be based, whenever it comes to payable, it will only be based on your 5,000. So therefore 5,000 into, originally you had assumed that you have to pay only 60. You have to pay only 60 rupees per dollar. But now you get to know that you have to pay 65 rupees per dollar. That means you have to pay rupees 5 per dollar extra. And how many such dollars you have to pay? 5,000 such dollars. So therefore 5,000 into 65 minus 50, that is your 5 rupees. So 5,000 into 5 becomes 25,000. So therefore, this is your 0.25. Okay, this entry is clear. Now what happens on 31st March 24? Another thing also happens, that is your revaluation. So first we only calculated this was your loss due to forex. That means this entry, forex loss. Okay. Next is your on 31st March 24 also revaluation happens to this machinery which you have shown at 3 lakh. Is it actually 3 lakh? No, you have to increase the value because now the rate is what, 5,500. So what do? Machinery will be first of all debited. Okay. So let's keep the amount aside for one time. To reval gain, of course, there is a revaluation, there is a upward revaluation of $500. So 500 into your original, your rate will be original because we have already recognized the loss. So 500 into your original rate will be this 0.3, and your forex gain will be 5,500 into 65 minus 50. Understood? So 5,500 into 65 minus 50, that is your 5. So 5,500 into 5 becomes your forex gain, that is your OCI. This is because revalued amount. So this is 0.275 and the balance over here comes to 0.575. Okay? So first to identify what will be your reval gain. Your reval gain is your change, that is fair value change. If you have to put this into a formula, this will be change in fair value into original exchange rate. That is, in this case, original exchange rate was 16, change in fair value was 500. Okay. To understand foreign exchange gain that is transferred to OCI, this is new fair value. This is basically a new fair value into change in exchange rate. Great. Okay. Now coming to 31st March 25, when you actually have to pay this. So your payable, if you see, your payable was shown at what? How much? 3 lakh. Plus you passed another entry of payable of 0.25. So your payable is currently shown at 3.25, right? So your 3.25 is your payable. So therefore we are debiting payable. How much are you actually paying? You are actually paying 3.35. That is, you are actually paying 5,000 into 67. Correct? And this rate 3.25 that you have is basically 5,000 into 65. So basically there is still a gap of 5,000 into 2 rupees because you have recognized it at 65, but the actual exchange rate on the date of payment becomes 67. So there is another loss of 2 rupees per dollar. That is your 0.1 becomes your 5,000 into 2. That is your 10,000, and in terms of lakh it is 0.1. So therefore this is your journal entry because there is still 2 rupees that you had left over here at the time of making payment. And last comes your on 31st March 25, that is machinery to foreign exchange gain. That is 5,500 into your 2 rupees difference, 67 and 65. So machinery is debited. Machine is again brought to increased value by 2 rupees because now the rate is 67. And as we are following the fair value method, so therefore your exchange rate on the date of fair value determination. So therefore we have increased the value by 2 rupees again, machinery to foreign exchange gain. And with this we are done with this chapter. I hope this question is very clear with you, and I will see you in the next chapter.